Have you ever stared at your retirement account options, feeling like you're trying to decode ancient hieroglyphics written by caffeinated financial advisors? You're not alone. When most people open up their 401k menu for the first time, they're greeted with a bewildering array of fund names that sound like they were generated by throwing alphabet soup at a wall. Large cap growth, mid cap value, international emerging markets, target date funds, and somewhere in that maze of confusion sits something called the S&P 500 index fund. Now, if you're like most people, you've probably heard the term S&P 500 thrown around more than a football at a tailgate party, but you might not actually know what it means or whether you should care. Maybe you've seen it mentioned in news headlines when the stock market has a good day or a terrible one. Perhaps your coworker who thinks he's the next Warren Buffett keeps talking about it during lunch breaks. Either way, you're probably wondering if this mysterious S&P 500 thing is something you should be investing in or just another financial buzzword designed to make you feel inadequate. Well, here's the thing that might surprise you. The S&P 500 isn't just some random collection of stocks that Wall Street executives picked out of a hat during a particularly boring meeting. It's actually one of the most important measurements of how the American economy is performing, and understanding it could be the difference between retiring comfortably and working until you're 90 because you thought investing was too complicated. My name is Nick, and I spend way too much time thinking about money, investments, and why most people would rather watch paint dry than learn about their retirement accounts. If you're someone who wants to understand how to build wealth without getting a PhD in finance, make sure to hit that subscribe button and give this video a thumbs up if it helps you make sense of this whole investing thing. Here's what most people don't realize about retirement planning. The average person will change jobs multiple times throughout their career, and each time they do, they're faced with a new set of investment options that look completely different from their last employer's plan. One company might offer 15 different fund choices, while another offers 50. Some have fancy names like aggressive growth portfolio, while others have boring names like stable value fund, and somewhere in that mix you'll almost always find an S&P 500 index fund option. The reason this fund shows up everywhere isn't because fund companies are lazy or uncreative, it's because the S&P 500 represents something pretty remarkable in the investing world. Think of it as the ultimate popularity contest for American businesses, except instead of voting for prom king, we're measuring which companies are actually worth the most money. But before we dive into what makes the S&P 500 so special, let me ask you something. When you think about the most successful companies in America, what names come to mind? You're probably thinking about Apple, Microsoft, Amazon, Google, Nvidia, maybe Netflix or Tesla. These aren't just companies you've heard of. They're companies that have fundamentally changed how we live, work, and spend our money. Well, guess what? Most of these companies are sitting right there in the S&P 500, and when you invest in an S&P 500 index fund, you're essentially buying a tiny piece of all of them at once. Now, you might be thinking this sounds too good to be true. How can one investment give you exposure to hundreds of the most successful companies in America? And more importantly, why isn't everyone doing this if it's so great? These are excellent questions, and they get to the heart of why understanding the S&P 500 is so important for anyone who wants to build wealth over time. The S&P 500 is what's called an index, which is basically a way of measuring how a specific group of stocks is performing. Just like how the temperature outside gives you an idea of whether you should wear shorts or a winter coat, the S&P 500 gives investors an idea of how the overall stock market is doing. But unlike checking the weather, which tells you about right now, the S&P 500 can help you understand long-term trends in the American economy. Here's where it gets interesting. The S&P 500 doesn't just randomly pick 500 companies and call it a day. There's actually a committee of very serious people who spend their time analyzing companies to determine which ones deserve a spot in this exclusive club. Think of it like the admissions committee for the most prestigious university in the business world. Except instead of looking at test scores and essays, they're examining things like market capitalization, financial stability, and trading volume. To get into the S&P 500, a company needs to meet some pretty specific requirements. They need to be based in the United States. they need to be worth multi-billion dollars, and they need to have been profitable in their most recent quarter. They also need to have been publicly traded for at least a year, which means no brand new companies that might disappear as quickly as they appeared. This screening process is actually one of the reasons why S&P 500 index funds have been so successful over time. You're not just buying random stocks and hoping for the best. You're investing in companies that have already proven they can survive and thrive in competitive markets. It's like having a team of professional scouts pre-select the players for your fantasy sports team. Except instead of trying to win your office league, you're trying to build wealth for retirement. But here's something that might surprise you about how the S&P 500 actually works. Even though it includes 500 different companies, they're not all treated equally. The bigger and more valuable a company is, the more influence it has on the overall performance of the index. So when Apple has a great day and its stock price goes up, it affects the S&P 500 much more than if a smaller company has the same percentage increase. This means that the top 10 companies in the S&P 500 actually control nearly 40% of the entire index's performance. We're talking about tech giants like Apple, Microsoft, and Amazon, along with companies like Berkshire Hathaway, Tesla, and Johnson & Johnson. When these companies do well, the entire S&P 500 tends to do well. When they struggle, the whole index feels it. Now, this concentration in large companies isn't necessarily a bad thing. These are businesses that have proven they can generate massive amounts of revenue and profit. They've survived economic downturns, adapted to changing consumer preferences, and continued growing even as smaller competitors have fallen by the wayside. In many ways, investing in the S&P 500 is like betting on the continued success of American innovation and entrepreneurship. But here's where things get really interesting, and this is something most financial advisors won't tell you because it doesn't involve selling you expensive products. The S&P 500 has a track record that would make most professional money managers weep into their $1,000 suits. Over the past several decades, this seemingly boring index has consistently outperformed the majority of actively managed funds, despite having fund managers with fancy degrees and even fancier expense accounts. Think about that for a moment. You've got teams of highly educated professionals spending their days analyzing company earnings reports, meeting with executives, and trying to predict which stocks will outperform the market. They're getting paid millions of dollars to beat a simple index that just follows a set of rules. And yet, year after year, most of them fail to do it. It's like watching a group of professional chefs lose a cooking competition to someone following a recipe they found on the back of a cereal box. The numbers don't lie, and they're pretty embarrassing for the active management industry. According to research from Standard & Poor's, over the past 15 years, roughly 90% of actively managed large cap funds have failed to beat the S&P 500. 90%. That means if you picked 10 random fund managers and gave them your money, 9 of them would have done worse than if you had just bought an S&P 500 index fund and took a 15-year vacation. Now, you might be wondering how this is even possible. How can a fund that requires zero human decision-making consistently outperform funds managed by people who supposedly know what they're doing? The answer lies in something that sounds boring, but is actually fascinating when you understand how it works. It's called the efficient market hypothesis. And while that name might make your eyes glaze over faster than a donut in a bakery, the concept is actually pretty straightforward. The basic idea is that stock prices already reflect all available information about a company. When news comes out that Apple has invented a new product that's going to revolutionize the tech industry, that information gets incorporated into Apple's stock price almost immediately. There are thousands of professional investors watching every piece of news, every earnings report, and every market trend. They're all trying to find stocks that are undervalued or overvalued, but because there are so many smart people doing this, it becomes incredibly difficult for any one person or team to consistently find opportunities that everyone else has missed. It's like trying to find a $20 bill on the sidewalk in Times Square. Sure, occasionally someone might drop money, but with millions of people walking around looking at the ground, Those bills get picked up pretty quickly. The stock market works similarly, except instead of looking for dropped money, investors are looking for mispriced stocks, and there are computer algorithms that can spot and act on price discrepancies in milliseconds. This brings us to one of the most important concepts in investing that most people never learn. It's not just about picking good investments, it's about avoiding bad ones. And one of the worst types of investments you can make is paying high fees for performance that you could get cheaper elsewhere. When you invest in an actively managed fund, you're typically paying expense ratios of 1 to 2% annually. That might not sound like much, but let me put it in perspective. That will make you question every financial decision you've ever made. If you invest $10,000 in a fund with a 2% expense ratio, you're paying $200 per year in fees. If that same money grows to $100,000 over time, you're now paying $2,000 annually. When it reaches $500,000, those fees hit $10,000 per year. You're essentially buying someone a very nice car every single year for the privilege of them probably underperforming an index fund that charges $3 annually on the same amount of money. But the fee structure gets even more ridiculous when you consider something called compound costs. Those fees aren't just taken out once, they're taken out every single year, which means you're losing money on the fees themselves over time. If you had invested that fee money instead of paying it to fund managers, it would have been growing along with your other investments. Over a 30-year period, high fees can easily cost you hundreds of thousands of dollars in lost growth. This is why Warren Buffett, arguably the most successful investor of all time, has repeatedly recommended S&P 500 index funds for most individual investors. In fact, he was so confident in this recommendation that he made a famous bet with a group of hedge fund managers. Buffett wagered that an S&P 500 index fund would outperform a collection of hedge funds over a 10-year period. The hedge fund managers were so confident in their abilities that they took the bet, figuring they could easily beat a simple index fund. 10 years later, Buffett had won by a landslide. The S&P 500 index fund returned over 7% annually, while the hedge funds averaged less than 3% after fees. Keep in mind, these weren't random fund managers picked off the street. These were supposed to be some of the smartest money managers in the world, and they got demolished by an investment strategy that requires zero skill, zero research, and zero market timing. The beauty of S&P 500 index fund investing is that it removes the human element that often leads to poor investment decisions. You don't have to worry about a fund manager getting overconfident and making risky bets with your money. You don't have to concern yourself with style drift, where a fund gradually changes its investment approach without telling you. You don't have to monitor manager changes or wonder if the person who built the fund's track record is still making the decisions. Instead, you get something beautifully simple and predictable. When American businesses do well, your investment does well. When they struggle, your investment struggles. But over long periods of time, American businesses have shown a remarkable ability to adapt, innovate, and grow, which has translated into consistent returns for S&P 500 investors. Now, let's talk about what these returns actually look like in real numbers, because this is where the S&P 500 goes from being an interesting investment concept to being a legitimate wealth-building machine. Over the past 90 years, the S&P 500 has averaged annual returns of approximately 10%. Some years it's up 30%, other years it's down 20%, but the long-term average has been remarkably consistent. 10% might not sound life-changing until you see what compound growth can do over time. If you invested $1,000 per month in an S&P 500 index fund starting at age 25, by the time you reached 65, you would have contributed $480,000 of your own money, but your account balance would show approximately $2.6 million, assuming a conservative 7% return to account for inflation. That extra $2.1 million didn't come from working harder or getting lucky. It came from owning tiny pieces of American businesses and letting compound growth work its magic over 4 decades. But here's what makes this even more powerful when you think about your actual retirement timeline. Most people start seriously investing in their 30s, which means they have roughly 35 years until retirement. During that time frame, you're not just earning returns on your initial investment. You're earning returns on your returns, which then earn returns on those returns, creating this beautiful mathematical snowball effect that would make even the most jaded accountant shed a tear of joy. Let's say you're 30 years old and decide to max out your Roth IRA contribution of $7,000 to $8,000 annually by investing in an S&P 500 index fund. Assuming that same historical 10% average return by age 65, you would have contributed roughly $227,000 of your own money, but your account balance would show approximately $1.4 million. That's over $1 million in growth that came from simply owning pieces of American businesses and having the patience to let time work in your favor. Now, some of you might be thinking that 10% sounds too optimistic, especially if you've lived through market crashes or economic downturns, and you're right to be skeptical because the stock market doesn't hand out 10% returns like a friendly neighborhood ice cream truck playing the same tune every day. Some years, the market drops 20 or 30%, and when that happens, watching your retirement account balance can feel like watching your favorite sports team blow a 20-point lead in the final quarter. But here's something fascinating about market volatility that most people don't understand until they've been investing for a while. I guess those scary market downturns actually work in your favor when you're consistently investing over long periods. It's counterintuitive, but bear markets are like Black Friday sales for long-term investors. Like when stock prices drop, your regular contributions buy more shares for the same amount of money. Then when the market recovers, and it has recovered from every single downturn in American history, those extra shares you picked up during the scary times become incredibly valuable. Think of it like this. If you're buying groceries every week and suddenly everything goes on sale for 50% off, you're not upset about the sale. You're excited because your grocery budget just became twice as powerful. The same principle applies to investing in index funds during market downturns. Your monthly contributions suddenly buy twice as many shares, and when prices return to normal levels, you own significantly more pieces of those companies than you would have if prices had stayed stable. This is why successful long-term investors actually get excited about market crashes rather than panicking about them. They understand that volatility is the price you pay for higher returns, and they're willing to accept short-term discomfort for long-term wealth building. It's like agreeing to sit through a really turbulent airplane ride because, you'll end up somewhere amazing, but let's address the elephant in the room that every financial advisor will eventually bring up during their sales pitch. They'll tell you that while the S&P 500 is fine for beginners, serious investors need more sophisticated strategies. They'll throw around terms like tactical asset allocation, alternative investments, and market timing strategies. They'll show you charts demonstrating how their actively managed funds have outperformed the index over certain cherry-picked time periods. Here's what they won't tell you. Those performance comparisons almost never include the impact of fees and taxes, which can completely wipe out any advantage their fancy strategies might have provided. They also conveniently forget to mention that past performance has absolutely no bearing on future results, despite being legally required to say exactly that in their marketing materials. The dirty little secret of the investment industry is that complexity sells better than simplicity, even when simplicity produces better results. A financial advisor can't charge you significant fees for recommending that you buy an S&P 500 index fund and hold it for 30 years. There's no ongoing management required, no quarterly strategy meetings, and no justification for their existence. But they can absolutely charge you for constantly tweaking your portfolio, switching between different fund families, and implementing sophisticated strategies that sound impressive but often underperform the simple approach. This brings us to one of the most important questions you'll face as an investor. Do you want to be right or do you want to be rich? Because sometimes being right means accepting that the boring, unsexy strategy is actually the most effective one. It means acknowledging that you don't need to beat the market to build substantial wealth. It means understanding that trying to be clever often leads to being poor. So there you have it. The S&P 500 isn't some mystical financial instrument that requires a PhD to understand. It's simply a way to own pieces of America's most successful companies without having to research each one individually or pay someone in an expensive suit to pretend they can predict the future. Whether you choose the basic S&P 500 index fund or opt for something with a bit more growth potential is entirely up to your risk tolerance and timeline. Just remember, the best investment strategy is the one you'll actually stick with for decades, not the one that sounds the most impressive at dinner parties.